look ahead into the future, figure out what the markets would do and what investors should be doing. We've got Harsha Upadhyay joining in on the show right now. Harsha, hi, morning. Good to have you on the show. Harsha, a lot of news flow now seems to be getting addressed pretty much along the expected lines from the market, be it domestic or for that matter now at the Fed as well. Of course, the big overhang continues on the US tariffs, but hopefully there should be a resolution to that as well. You think all baked into the markets, or do you think the markets would await to see what the consumption fillip is after the GST comes into effect come 22nd, the slab changes that is, and then perhaps directionally move higher from here?
Good morning, Ayesha. If you look at GST related upside or sentiment change, I think more or less that has played out in the very near term, in our opinion. Most market participants understand that probably Q2 numbers are not going to be as expected earlier. There will be some deferment of purchases into Q3. But when you look at Q2 and Q3 together, I think there should not be any disappointment. And probably given the fact that GST reforms are structural in nature, this upside should continue over the next few quarters, few years as well. However, what is not priced in by the markets yet is probably any resolution to India-US trade relationship. Anything positive coming out of that in the near term could increase foreign participation in India. If you look at last couple of months, we have seen some flows from developed markets flowing into emerging markets for many of the emerging market economies. There has been inflows in the past couple of months. However, India has been an exception. And what has happened in this phase is the usual premium that India used to trade at vis-a-vis emerging markets has come off quite a bit. On a 5-year average, India has an average premium of about 70% over emerging markets. And now that premium has shrunk to close to about 40 or 45%. While we are still a little bit expensive compared to emerging markets, but I think given the fact that over the last year, India has underperformed and off late as well, because of the trade issues, we have not seen large flows coming from FIIs. That could change if there is any early resolution to US-India trade negotiations.
But Harsha, what about earnings per se? You know, while of course, because of the GST rationalization coming into the fore in 22nd, there will be a quarter's delay to see all that momentum and, uptick in demand. But I was just looking at the advanced tax collections numbers as well. Heartening to see that perhaps the previous quarter numbers, or rather this quarter's numbers, are going to be a lot better than what we saw in the previous quarter.
The expectation for full year financial year 26 is probably a low double digits kind of earnings growth for Nifty basket and slightly higher for mid caps. However, small caps are continuing to disappoint with negative earnings growth even at this point of time. And past 3 quarters as well, they've been on the declining mode. I think there is unlikely to be very large change to financial year 26 earnings. Even with GST cuts coming in, I think more or less it's going to pan out the way that most people are expecting. However, the confidence on some recovery in financial year 27 would increase with this GST reforms implementation. And we do believe that gradually you're going to see a better earnings trajectory for Indian corporates. We are expecting about 14% earnings growth for financial year 27 for Nifty basket. So overall, yes, from here on, you should see a gradual and a sequential improvement in terms of earnings trajectory. And if along with that, if you see any resolution on the trade negotiations, I think that should be very positive for Indian markets.
Well, yes, that is the hint is that we are getting to understand. Hi, Harsha. Morning. This is Shrishti and good to be speaking with you. And I wanted to understand how do you make the changes in your portfolio? Because back home, there's a lot of excitement with respect to the domestic counters and the domestic facing industries. But given the fact, Harsha, on the tariff front as well. The commentaries now seem to be turning a little bit more positive. Is this a time to maybe look out for some of these export-related sectors, be it IT, pharma, textile, anything that you are liking at this point?
Srishti, we still favor domestic businesses even at this point of time. At the same time, we are not avoiding some of the export-oriented sectors, whether they are impacted by tariffs in terms of earnings or not. But I think sentimentally, most of these sectors are impacted by what's happening between US and India. So to that extent, if there is a resolution, there would be some near-term sentiment change on some of these sectors. However, when you look at the next couple of years of earnings trajectory, I think clearly, even without GST reforms, domestic businesses were supposed to deliver better earnings growth than some of the exporting segments. And with GST implementation, I think there is a lot more confidence on that panning out the way that we are expecting. So I would say that if you leave out very near term in terms of what's going to happen to tariffs and how each sector is going to behave post that, etc., overall, from an earnings perspective, I think there is a lot more confidence on domestic businesses, by and large, outpacing exporters. And given that view, we continue to favor domestic businesses in our portfolio.
Right, okay, so that's the take coming in. But Harsha, hi morning. This is Snehi also joining in the conversation. I remember last time when we interacted, you were bullish on the chemical space as a theme. Now that there are more, leg ups to this theme coming in from the government in terms of GST cut across most chemicals, and PM Modi's a speech wherein he stressed upon the need to manufacture fertilizers locally. How much of a positive further are you seeing for the chemical space, and if at all you've increased any allocation towards it?
Snehi, we have not increased our allocation to chemicals. We continue to remain overweight. However, we have not increased it in the recent times. We do believe that it will continue to outperform overall markets at this point of time. However, taking further overweight may not be necessary, given that there are other segments in the domestic businesses which are also likely to see some tailwind, especially consumption-oriented sectors after these reforms. And also, we do believe that financials, by and large, have kind of seen NIM compression playing out. Probably there is one more quarter of NIM compression that you will see probably in the second quarter results that will come out. And thereafter, we do believe that there would not be major or significant impact on net interest margins, and credit growth should also improve quite a bit. So given this, we do have reasonable positions in financials and consumption-oriented basket as well.
Harsha, you also seem to be liking the chemical space, and you believe that that sector is actually showing some signs of a turnaround. What's your current take on the chemical basket? And since the whole sector is so much diversified, anything in particular that you are liking at this point?
Srishti, we continue to favor specialty chemicals and some of the fertilizer names from the domestic side of the chemicals business. We continue to believe that the kind of oversupply that we have seen in the specialty chemicals and destocking-led margin compression that we have seen is probably behind us, and we should continue to see gradual improvement in terms of both pricing as well as margins for this basket. And also the anti-involution steps that are being taken by China is definitely a structural positive for the chemicals industry. A lot of the excess capacity from China could be out of the market going forward, which means that the supply could get constrained more than what everyone is anticipating, and also the pricing could remain quite healthy. So given all this, specialty chemicals should continue to behave quite well compared to their recent history, in our opinion. And that's where most of our overweight positions are.
Right. Harsha, do you also take some strategic allocation calls? I mean, do you ease off from capex, add more to consumption?
Aisha, I think over the last few quarters, we have been gradually booking profits in some of the capex-oriented or economic recovery-oriented basket, investment-driven businesses, I would say. And I think that shift will continue even going into the future. Not that there is anything big negative in capex related segments, but from a valuation perspective, they more or less discount most of the upside. And from here on, the government capex is likely to be in low double digits, broadly in line with a nominal GDP growth, which means that the kind of large impetus that we had seen on a year-on-year basis between, let's say, 2020 to 2023 or so, may not continue going forward. While the earnings will be healthy, it may not be as strong as what we had seen in the past, and also may not outpace the market average earnings growth by the same margin. So to that extent, I think there is merit in diversifying our portfolio into more of consumption-oriented positions now.
Makes sense. Harsha, always great chatting with you. Thank you so much for your insights today.
Thank you, Aisha.